Hi, this is Anthony Parent of IRS Medic, and yesterday, we heard some big news. On March 3rd, the IRS announced Revenue Procedure 2020-17, and this gives some massive relief to people abroad and people in the U.S. who have foreign retirement accounts, because it limits some of those nasty reporting obligations for Form 3520, Form 3520A, automatic $10,000 penalties often assessed, and the IRS, on the 3520A, the IRS can actually assess a portion of the value of the retirement fund. So joining me today is our friend Keith Redmond and John Richardson. Keith runs American Expatriates 2.0. It's a blog for Americans overseas. I advise you to join that on Facebook if you're looking for to find a group of people. Keith, so what's your questions that you have for us?
Well, I guess, I'm the layperson on this particular call with you both knowing this very well. So when this news came out yesterday, I know what's going to happen. I'm going to get messages and calls from people saying, okay, I have a retirement account, whether it be public or private, in the country I live. What does this mean for me? How will this affect me? Well, it sounds to be a benefit, but I don't know. So that's why this particular podcast is going to be good, because I'm going to need to know from a layman's perspective how to answer some of these questions and to guide them to somebody like you, Anthony, or you, John.
Oh, thank you very much. Thank you for that question. Well, joining me is John Richardson, and he runs citizenshipsolutions.ca. And I actually have an article that he wrote up yesterday sort of saying, hey, this is a good thing. So, John, is this a good thing or a bad thing?
Well, it's obviously a good thing. The question is, how good of a thing is it? In other words, how many people does it actually help? My initial impression of this is that it is going to make tax filing an awful lot easier for a lot of people. Let me put it this way. I think it's going to help a lot of people a lot, and some people just some, depending on the sophistication. What this is, if I can just sort of summarize the purpose of this, backing up, we're all of us on this call are aware of what I call the 3520A penalty fundraiser that's been going on the last year, where all kinds of people have been getting these $10,000 penalties for misfiling Form 3520A, which is triggered only by filing Form 3520. So in other words, the first step in getting the penalty was filing a Form 3520. So what's a Form 3520? Well, Section 048 of the Internal Revenue Code, which I understand took effect in 1996, basically requires reporting of almost any interaction with what's defined as a foreign trust. Now, obviously, a foreign trust would be a non-U.S. trust. Treasury has its own definitions of what constitutes a trust, by the way. And there are a lot of things that are called trusts in other countries that I don't qualify, in my view at least, as trusts from an IRS point of view. And this would include most Canadian TFSAs or an ISA in the UK, for example. But nevertheless, there are things that are trusts, and I think there's general agreement that pension plans, company pension plans, are often treated as trusts. There are other kinds of retirement planning vehicles that have the word trust associated with them. Now, what this revenue procedure has done is essentially the IRS has seen and understood that a lot of the things that might technically be trusts and are referred to as trusts in other countries either are really so trivial in terms of the objective of the foreign trust reporting requirements that they shouldn't be subjected anymore to the reporting required by Internal Revenue Code 6048, which shows up on a Form 3520. So now I want to make it very clear, though, that to the extent that this is helpful, it is removing a reporting requirement, a specific one, the 3520. It has nothing to do with the taxability of these sorts of things. For example, a Canadian TFSA is generally understood to be taxable in the U.S., that is the income, So perhaps you don't have to file a 3520, but you do have to pay the tax on it. It also has no effect on any of the other reporting requirements. For example, Form 8938, the Statement of Foreign Financial Assets. And interestingly, right in the first couple of paragraphs of the actual revenue procedure, they made the point that one of the reasons why perhaps it wasn't all that big of a loss to get rid of the 3520 was because people would be reporting this on their Form 8938 anyway. And of course, these things are almost always subject to the FBAR regime as well.
And also, John, with FATCA, that this information is being shared with the IRS. So it's like, okay, we're getting relief on this reporting, removing the 3520 and or 3520A. But it's like, okay, so you're just saying we only need to, instead of reporting 4 times with the 3528, 8938 FBAR and the third party reporting of the foreign financial institution, we're only going to report it 3 times now. But in IRS world, that's actually massive success, I would say.
But if I can just suggest something here, Anthony, so on the FATCA IGAs, right, for every country, there are carve-outs for things that are not required to be reported by the banks, and these would be things like TFSAs or, in other words, these specific tax-advantaged accounts that this revenue procedure seems to me to be aimed at. In other words, they're not being reported by the banks anyway, but they are required to be reported by the individual in the 8938. But what occurs to me is that in trying to determine whether the type of account you have qualifies under this, I might be inclined to look to the FATCA IGAs and see if it is actually mentioned in the FATCA IGA. As the kind of account that does not have to be reported, because I think that would, it would seem to me that my reading of this thing suggests huge overlap, in this area. So that would, I think, be a good thing to do. Now, also, let me just say that very, very clearly, this is not going to apply to the whole universe of financial products for Americans abroad. And some people are going to need, advice in this area for sure. And, they should, I think, get that kind of advice. There are also, in a minute, we'll go through to the extent that we can the technicalities of this. But let me just pause for a minute. That's, I think, what I'd like to say to get us moving in the right direction. This is, after all, 48 hours old, okay? It's not as if, there's been time to...
Well, and I would say this, as I look through this, John, I think one of the most important things that we recognize is like, yes, this is a great relief. And I would say, and I think that's great. For most people, this is great news. For some people, this is good news. For some people, it doesn't affect whatsoever.
But you know what, Anthony? I think for everybody, this is actually not great, but fantastic news. And let me explain why. Because, I think you and I have either talked about this or talked around it in previous podcasts. My view of this is that most of the problems experienced by Americans abroad can be solved directly by Treasury. One small example was, this didn't go far enough, but a small example was establishing a higher 8938 threshold for Americans abroad than for Homelander Americans. Another one, would be this sort of thing here, right? I had suggested a while back in a conversation with somebody or other that what Treasury really ought to do is just simply say, we're going to look to the FATCA IGA, see what the accounts are that are not required to be reported, and just do a blanket reporting exemption, for those accounts. So this is movement in the general direction of Treasury taking steps to help people. A year ago, they interpreted the Section 962 election in a way to be, that turned out to be very, very helpful. I wrote a post on this recently. They have the complete authority to exempt Americans abroad from FBAR requirements. They also, in my
Yes.
view, if you look at the 5471 regulations, and if you read I know that you work in this area, so I would invite you to read the part of the regulations where they coordinate the 5471 with the tax treaties. And they actually have, I would say, a partial carve out for, people who use the tax treaty tiebreaker. For non-residents on this sort of thing. In other words, they've sort of flexed their regulatory muscles in a way that shows when they want to make it easier for people, they can. And I see this as as hopefully a first step in really eradicating the problems of citizenship taxation. This isn't necessarily the final word on this revenue procedure. They see how it works, and maybe they provide more exemptions or something. So this actually, if you can kind of remove yourself, listeners, from how does this affect me personally for a moment, and if you think in terms of solving the problems of Americans abroad in general, that is short of getting rid of citizenship taxation, which is obviously the ultimate solution. But I see this as a very, very positive step, towards alleviating this. And I also would like to give a shout out to, people who've been working very hard on this. I mean, I think Kat Jennings at Tax Connections has been a real hero in publicizing all this stuff. And certainly people like Gary Carter, who God knows how many posts he's written on this, have, really been helpful.
Yeah, and I guess, John, I'm a little torn because and we've talked about this before. If you have a horrible law, enforce it to the letter, and that's a great way to get rid of the law. And so we have this citizenship-based taxation, and it's really hard to, as you're reading through these things, and you're looking at how much of the English property law is into our U.S. tax law. And you see that, and you see these terms being applied in other countries that have none of that property law. That's not their basis. It's not where they come from. And so it's just sort of this egocentric thing that sort of gets, and because it's a bad idea to begin with, to claim a taxing jurisdiction where you don't have physical jurisdiction is a horrible idea. Okay, we're not there yet. So I would say, I think this is kind of a good thing because, well, here's what we have. Well, it actually is being enforced to the letter. And here's Treasury saying, you know what? This is killing us too. So here's what it is. And so I think this can be the momentum and get a lot of conversations going. Why do we need that 5471 with so much information? Why can't we have a carve out of the same thing? Why can't we have a carve out for an 8865? Why, who does these forms help? And I'll be honest, because this is what happens. You're throwing these people who, they don't have the money. They live in a place that doesn't have the exchange rate where they get whacked. Maybe they'll do compliance, but they stop because it's insane. I think this is because we know what there's 8 million people around the world who live around the world. There's only like 1 million taxes by expats filed. Okay, so you have a wild non-compliance rate. I think this will help because most people around the world, they don't have a lot, but they have something, and if your pension account goes from, whether it's $10,000 or $1 million. For us, prior to this, it's kind of the same amount of work, unfortunately. So you're going to be paying your tax prep could often be the tax prep bill for somebody with a lot more assets than you. So this gets to that. The reason why it gives incentive is because your tax preparation bill will be lower. And if you look around, and I think what we charge is competitive. It still can be an expensive form to complete. You're looking, for somebody, something simple, it's $150 to, maybe it could be, we get a 3520A. Oh, you could be looking at a couple $1,000s per year. Something like a self-managed a superannuation fund, something like that. You're looking at a couple $1,000s a year. So for someone like that, like, oh my God, I'm going to sign on to this U.S. tax compliance. This is going to be horrible. It's like, well, actually, unless now here's some important things. And here's some tricks that you got to watch out for. Just like everything with the IRS, there's nothing free. There's always catches, okay? So here's the catch. Your contributions can't be any more than $1 million. Otherwise, you do have that 3520 or 3520A requirement. That means you have to keep track of all your contributions. Now, and John did point out to me earlier, it's not value. So if it's over $1 million, and that's not the trigger, it's what your contributions are. Now, a question comes into play. Do we count employer contributions as your contributions? Probably. Probably we would. I would imagine so. The other thing, too, in order to use this, it says in here, and I just had it up here. Let me get the part up. Let's talk about who can use this. The only people who can use this are people who have been in tax compliance. So if you've not been in tax compliance and you say, hey, I'm just going to use this, guess what? You can't use it. The IRS can actually come back and hit you with those 3520A penalties, 3520 penalties if you weren't in compliance. The people who can use this are people who have been filing correctly all along or use something like a streamlined disclosure program. All of our clients are in good shape. Yeah.
Yeah. So there's no, so I just want to make sure I understand. So there's really no incentive for someone who's not in the U.S. tax system to do this because they can't take advantage of this.
That's right. If you're not in the system, you can't use it. So if you're not in the system, then if you contact us, hey, you know what, this seems like a good idea, we would check to see what your compliance is and what you need in order to do it. Now, this is a very, when you look at these, look, there's a lot to this. When they're talking about compliance, what do they mean by that? We know what it means, but this revenue procedure doesn't exactly explain it entirely. And one thing that's critical to it does not affect your underlying tax liability. If you have an underlying tax liability for your foreign retirement account with a 3520A or without, it's the same. You have to do that. So here's the thing. If you have not been paying your taxes on that, because I've seen this, I've seen a lot of this out there, people making some claims about what the tax law is, and so they'll make this claim saying it's not taxable because of this. The reasoning is nonsense. It's wish casting. We hope for it. We would hope that's the way someday, but there's really nothing there. There's no law to support the position. The IRS, my guess would say, you know what, you're not in compliance. So for all those people who took interesting positions, I would say maybe not use this, or maybe clean up anything that you have done in the past with anybody who's a little bit shady, so that you can take advantage of this year after year.
Well, okay. What about, could somebody use this in a streamlined? I don't see any reason why if somebody does a streamlined filing from this point on, that they can't omit the 3520s relying on.
Yeah, and that's right. Yeah, absolutely. And I think this is really one of the terms of art you need to see, because when you go through this Section 5 definitions, eligible individuals, it says, for purposes of this revenue procedure, an eligible individual means an individual who is, or at any time, was a U.S. citizen or resident. There's a meaning for that. And who, for any period during which an amount of tax may be assessed under 6501, without regard to that, is compliant or comes into compliance with all requirements for filing a U.S. federal tax return or returns covering the period such individual was a U.S. citizen or resident to the extent required under U.S. law, has reported any incomes or to the earnings of or distributions from an applicable tax-favored foreign trust on the applicable return.
Okay. So in other words, they're just saying if you've been reporting the income, then you can use this procedure.
Yes, but for how many years? What does that mean?
Well, what they said later in the thing was that, and this is why it's so, I think we should get a medal for talking about this, given that it's so new. But I thought what I read was that it said it was available for any and all open years.
Yeah, and that's the critical thing. So when you read that, and I would say this would be the confusing thing for a layperson. If I was a layperson, I would read this like, oh my God, I got to make sure every tax return I ever was required to file is correct or filed. No, it actually doesn't mean that. Compliance to the IRS doesn't actually always mean perfect compliance. The IRS just will come up with rules, and often one is when you have unfiled returns, often it's just 6 years you go back. Why? That's what the IRS says to do. Why? Because that's what they want to deal with. There's arguments you could make other years, but 6 years is just sort of the generally accepted one. However, if there's foreign things, maybe we go more. There's an FBAR 5-year statute of limitations we want to be aware of as well. So the point is, what's compliant for you could be different for than what someone else needs to do, but you have to make sure you're in compliance with this and really make sure with someone who actually sees challenges from the IRS. I mean, there are a lot of firms out there who never deal with any of this. And here's the truth. Okay. The IRS audit rate is down. So a lot of people who are filing things, making claims, their claims have never been tested. So they're going out there saying, oh yeah, this works all the time. Well, what happens when the IRS catches up? The IRS has a huge inventory of cases. Here's a whole, basically his client list becomes all the people he's going to assess penalties. And this penalty relief won't apply to you because you were in tax compliance, because you didn't pay taxes on something. You took an interesting position that you hope to be true, but without any support. So basically you would have to win in tax court, in district court, circuit court, U.S. Supreme Court in order for your claim to prevail, which is just sort of, federal courts tend to favor the U.S. government is sort of what I've seen. John, what would you like to add?
Well, let's just break this down and try to give what, I'm trying to imagine, anybody who's listening to this, some situations that they might wonder about. So, I mean, here's one that I think is an interesting situation. So, let's say we work with somebody in, let's say Canada, since this is where I live, who has been filing and has a TFSA, for example, tax-free savings account, or an RESP. Those are, culprits where, the income on those is not taxable in Canada. So it's very, very common for people to file U.S. tax returns and not include that as income, because it's not taxable in Canada, sort of thing. Now, they want to come into compliance. Let's assume they haven't filed any 3520s, which is most likely the case under that kind of scenario. Is there anything wrong with the following advice? Let's see. So streamline compliance to pay the tax, right?
Mm-hmm.
And since you're paying the tax, reporting the income, is there any reason why you can't exclude the 3520s?
Oh, in a streamline. Huh.
Yeah. What do you think? I mean, think out loud. Look, it's only 48 hours old.
Yeah, with the caveat, this is 48 years old, and there's still things, 48 hours old. So my guess is no. I would think you would. My guess is you would have to do that because you have to have compliance, then you get relief. You're trying to, that's sort of how I would think about it. Now, we also know, I think what we'll do is we'll probably put a call into the Streamline hotline. I think we're going to do that to say, what do you guys want? I think that's what we're going to do. And I think the thing is that they do make up the rules. There's not necessarily they will kind of make a rule that's a little bit more practical sometimes. And sometimes they've bent the rules to get something like, okay, it doesn't quite fit in, but we're going to make it work. So I think that's what we're going to do is we're going to put a call in. I could see them going either way. If it is, if it isn't required, it does reduce the cost a little bit of making a streamlined disclosure. It would be nice. But the plus is if you do have to do a 3520, because here's really the concern I have when I look at these exemptions. People's like, yep, I'll never have to worry about this form ever again in my life. Well, look, okay, maybe if you're a teacher, your contributions over your lifetime may not exceed $1 million. But if you were someone who's working for an investment banker in Hong Kong, you just started there, you have a few good years, they throw some bonuses in there, you could pop over that $1 million, kind of quick, and you're totally unaware that oh shoot, here's this trigger came up, and now you have this massive penalty exposure. And worse, your kind of filings indicate to the IRS, hey, you know what? Because you still have to report the taxes on it, right? You still have to report, and it still goes on your 8938. But you might be giving the IRS just enough information to say, hey, might be somebody we might want to examine. So that's the thing. Right. But that's a minority, and I would say that is a minority of people.
It's going to be a minority, but let's go back to, how this would affect, a normal person in Canada, UK, Europe, what have you. And I think it might be worth pointing out that this procedure seems to contemplate two specific kinds of assets, right? The first is what are seen to me to be traditional employer pensions. Now, these, in the case of Canada and the UK, are generally carved out under the tax treaties anyway, right? Okay, so, they're not going to be a problem there. Countries without tax treaties or with tax treaties where those are not carved out, that's where we'd have to look at, I think, more carefully at this. And so it doesn't have any effect on the income, right, which is either taxable under the Internal Revenue Code, excluded under the Internal Revenue Code, or excluded under a treaty. But if the contributions don't exceed $50,000 a year and $1 million lifetime, then it seems to say you're outside the 3520. So that's how it operates with traditional pensions. But a lot of retirement planning is no longer through traditional employer pensions, but through tax-advantaged accounts in other countries. So the second type of entity that this is aimed at is the tax-advantaged account. This is where I think it's more problematic, because it seems to be putting a $200,000 lifetime limit on contributions. Have I got that right?
That's right. That's the concern I have. Is like, okay, for your pure retirement, you have this. Most people won't have to worry about that. But this sort of definition of this other thing with a much lower, not tax favored foreign non-retirement savings trust, right? So they're,
for example, a Canadian RESP. My impression is that the critical mass of opinion in the compliance community is that RESPs are foreign trusts. Okay, I don't believe TFSAs actually are, but let's say an RESP is. Now, if we look at how it would affect that, contributions are limited to $10,000 or less annually, $200,000 or less on a lifetime basis. Now, part of the problem is it doesn't say who makes the contributions, and there's a matching program, I think, in Canada where the government of Canada contributes some of that. So I don't know how that factors in,
right.
But it does seem to me that that $200,000 thing is going to be a limiting factor. Also, as if you read the post that I put up it's up on Tax Connection, I included an email from Karen Alpert, who many of you will know is heavily interested and invested in the Australian superannuation. She gives her reasons why she thinks this would be unlikely to be helpful on the superannuation issue, or at least some of them. But where this is going to be helpful, at least I think where it's intended to help, are these things like RESPs and that sort of stuff, where people routinely don't include income and don't file 3520s. Anthony, my belief on this is that this is going to become more generous. When they see how the numbers actually limit this, because the principle of this seems to me to do the whole damn world a favor, especially the IRS, and not ask people to send these absolutely meaningless forms that are designed for things that really are trusts. When these things, there's no possible way these are trusts. I mean, they're highly monitored in Canada and the UK and everywhere else. Under the information exchange agreements and the treaties, the IRS can get any information on the stuff. It doesn't help them particularly.
Yeah, and I think this is really the thing. So there is going to be more to watch, and I would tell people this is really why you would want to subscribe. Because again, we hit this. It's 48 hours old. There's going to be. We still have a lot more questions that we want to know. We want to see how this plays out. We have a call into the disclosure hotline to see what they think. Because John's question is really good. That'd be nice if we could do that for our streamlined clients. That way, reduce their costs a little bit going forward. But yeah, a lot going on. Thanks for so much of your hard work. And you know what, John? I also think this. Here's the thing that I'm thinking of. You know, a lot of people get so down, nothing's going to change, nothing's going to change. Something changed here.
Well, this was very big.
This is changing, and you know, there's a little, you know, there's a fair amount of political dysfunction in Washington D.C. And so here's the thing: those of us looking for tax reform, we're kind of in the same position as everybody else looking for the United States government to change something. A lot's not getting done because of dysfunction. However, there are actually things that are actually on the front burner, or I guess maybe rear burner. And I think they'll move to the front if we're actually able to get people to work together. And maybe that is what the election of 2020 will result in. Because there's definitely some things. It is very different than it was 4 years ago with the awareness that Treasury has, the Taxpayer First Act Office, they're even getting involved. So there's a lot of positive changes, and so I would just advise people to watch. Let's keep the optimism going. Yeah, we got a lot of false starts. We get disappointments. We keep going, and this is absolutely a victory. Now, for those who want to use it, I think you've got to talk to a tax professional, someone who actually deals with the IRS on these penalties all the time. By the way, our clients have been getting these too.
Oh, Anthony, we forgot to say was that the procedure includes an opportunity to get a refund of penalties.
Right. That's right. Yeah. That's right.
Very important.
And so if you add paid penalties, and a lot of people probably have because
because they're U.S. citizens, they pay penalties. That's what U.S. citizenship is.
Yeah. So you can get it back. And one thing we don't know is can people get that 5% penalty they bet if they were U.S. based. So that's another thing that we would love to look into that, because I bet there's a lot of people interested in that one if some of it was related to 3520, 3520A. So with that, I want to sign off right now. Again, subscribe. What would you like to conclude?
Just 1 second here, Anthony, before we sign off. I think there's a really important message here for the community of Americans abroad as a whole into this, that I do think that it's important to keep the heat on Congress to try to get these laws changed. But I think it's also important to work very hard in getting Treasury to understand this stuff, because what I'm seeing is, gradually, sort of one at a time, that Treasury is providing relief. It's not perfect relief, but the point is that Treasury is doing things to make things better. And it's important to realize that and to keep the advocacy focus on Treasury every bit as much as on Congress.
And I think, too, is we want to reward them for helping us out. Instead of saying, you didn't go far enough, you jerks, say, thank you. Thank you. Here's some other things you may want to consider. That's sort of
that's right.
Probably the better approach.
Yeah, here are the things that are consistent with your initial objective that really should be considered as well. That's right.
So we do wish to thank the U.S. Treasury, and we had a couple attorneys on here on the RevProc. I think I'll call them out by name because I think this is really helpful, and definitely a lot of thought went into it. So this is Tracy Villico of the Office of Associate Chief Justice of International, and Lara Benjanin. They're both in on this revenue procedure. We want to thank both of them for this, and everyone involved at Treasury for getting this through. And hopefully we can have more. Again, what's the benefit of? These are small minnows. These are not the tax evaders you were looking for, I think is what we comes down to. All right, thanks again. And Keith has signed off. We want to thank Keith for joining us. He always asks so much questions. He's so helpful for really galvanizing the expat community. Again, this is Anthony Parent of IRS Medic. For John Richardson, I thank you for watching.